Thank you all for being here. We're going to go ahead and get started. We've got people on Zoom and people in the room. If folks straggle in, we're just going to keep going. My name is Robin. I'm the executive director here at SIMBA, who is doing this presentation tonight. I will not be doing most of the presenting. It'll be our talented CPA Amber Jasmin, who's one of our favorite people at SIMBA. But just a couple of things, kind of housekeeping. There are food and beverages in the back. Please help yourself. We are a small staff and we don't want to get physically larger, so we don't want to take all the food with us. So please eat. Food is local from Mason Jar because SIMBA, among other things, runs the Live Local INW directory, and we're an independent and local focused organization. So if we have an event, all of our food and drink is always local. At the front, when we're done, feel free to come grab handouts. I'm going to highlight a couple of them that might be worthwhile. There are some little packets that look like this. If you have a business, especially if you have employees at all, these are the current mandatory L&I posters. Take some with you. You need them in your physical spaces. The other ones you may want to look at, the first one is the teal card about Live Local that's up there. If your business is not on Live Local and you're independent and locally owned, we run a directory marketplace that is no charge for you and an events calendar. You can list your products, your services, link your website, promote your events. We have about 10,000 people a month going to our events calendar. So even if you're running a sale at your business or a promotion, people are looking at it. And I think the most important thing, and a preview for our third training that's coming up in this series, is that if you search a local business, if you put in Mason Jar, for example, usually the second hit on it is Live Local. So our SEO is pretty premium, and especially if you don't have your own website, I highly recommend you join. The only catch is you have to receive our newsletter. I don't care if you read it. It's once a month. If you unsubscribe, though, we will follow up and say, hey, do you want to stay on Live Local? So definitely check into that. If you are just a consumer and you want to look about keeping your dollars in our community, we have about 1,300 businesses on there, all the way to the Cascades, north to Canada, east to Idaho, south to Oregon. You can tell I've never said this before. But you can search, in Spokane, you can search by city, you can search by neighborhood, you can search by, I want to support a veteran-owned business or a women-owned business or a fill in the blank. And then in places like the Palouse, it's a little more just city-based because there's not as many places to have neighborhoods, but if you're looking like Garland, where am I going to eat? So keeping your dollars in our community, everything from my favorite, a witchy life coach, don't fully know what that is, might need one, to retail spaces, contractors, accountants, fill in the blank. The last card that is really relevant, and we'll talk about it a couple of times, if you need help with anything we talk about tonight that is not just filing your federal taxes, because SIMBA will not file your federal taxes for you, we have a little card about some of the services we can provide. One-on-one business consultations with myself and other staff members. Alexis is here in the corner. We have another staff member as well who's not here tonight. These are free. So everything from, we can help you with your state, B&O, and sales tax filings, setting up your LLC, helping you with marketing, any of those things, getting you ready to see your accountant to do your taxes, so it maybe costs a little bit more, or a little bit less, getting you ready for those things we can do. This training is brought to you by SIMBA, but also the Washington State Microenterprise Association. This is course 2 of 5. We haven't announced the extra credit one yet. But the first one was a couple of weeks ago in Colville. It was professionally recorded, which is why I'm talking in a microphone right now, and there's a video camera in the back. That'll be online, so if you missed it, it's about startups, compliance, licensing, all those things. It will be on our YouTube channel in a couple of weeks or a little bit longer, depending on how long they have to edit out all the filler words I used when I gave that presentation. Our third is about SEO and marketing. Our fourth is about goal setting and scaling, and our fifth is extra credit covering everything. So follow SIMBA's website for information. There's a clipboard there with information on our newsletter, where we do highlight our events. We also talk about grants and loan opportunities for small businesses in there. Again, once a month. You can click at the top. You don't have to read my executive director's letter. I will be sad about it if you don't, but I'll never know. So, but you can click to where you want to go in that. And just a couple of things, I'm going to skip through Amber's slides maybe. Just about who SIMBA is quickly. We are a 501c3 nonprofit. Our focus is education. We go by SIMBA because Spokane Independent Metro Business Alliance is a mouthful, but also because we work in 11 to 13 Eastern Washington counties. While our primary focus is education, we also do one-on-one consultations. We do group trainings. We have a YouTube with about 13 videos on it right now on everything from how best to utilize Live Local to how to file your B&O and sales tax filings and everything in between. We also educate consumers about keeping their dollars local, and all of our events and trainings are free. We have some add-on services for small fees to help keep our trainings free, including registered agent services. So if you're working out of your house and you don't want your address public anymore, we can help you with that at a low cost. WSMA, who funded this grant, funds entrepreneur support organizations, which is what SIMBA is. We help small businesses run their business. I think I tell people a lot, we're in the business of helping you run your business. They grant to organizations like us to provide trainings. We've been fortunate to receive several grants in the last couple of years, and so the School of Business is one of them. And we are most excited about being able to hire our friends at Vexing Media to do the trainings, or to record the trainings so that we can let you see them in the future. If you miss something, you want to pick up on it. WSMA focuses on micro businesses, which most of us are in this room. It's one that employs 5 or fewer people, including the business owner. So the business owner always works in a micro business. You're not a venture capitalist who just gets to buy something and have someone else do it. I had someone approach me the other day and say, do you know of any businesses for sale? And I said, what do you mean? I just want to buy something that's ready to go. And I'm like, yeah, I don't know that person, and that's not the work we do. Maybe there's some angel investors you should talk to. We deal with people who the business is everything they're doing every day. It's their family, it's their income, it is their life in and out. Generally, another marker of a micro business is you're not getting a giant loan from a bank to start off with, or you don't have an angel investor or funder. And usually it requires less than $50K of startup capital to start up. You don't need to buy a massive piece of equipment or fill in the blank. You're not doing a big tech IPO rollout. And in Washington, 85% of our businesses count as micro businesses, and they employ more than 600,000 people. In certain counties, like Grant, for example, 98% of the businesses are micro businesses. And with that, I will turn it over to Amber Jasmin from the Jasmin Group to talk about business finance basics. We have folks on Zoom with Alexis and myself. If you have a question, because we are recording, we're not going to record your faces, but we need to hear your voice. Raise your hand and we'll bring you the microphone. Thank you so much.
So, as she mentioned, I'm Amber Jasmin. I am one. There are 7 of us in my office. We do accounting, business consulting. We do a lot of similar things that SIMBA does, actually. We do some web and marketing, and we do a lot with nonprofits. So we have a lot of nonprofit clients, SIMBA being one of them, and I'm the only CPA, so you got me. All right, so this is kind of the overview of what I want to talk about today. Feel free to ask questions whenever you have them. I love interacting and having a dialogue. To me, it's a lot more engaging when you're able to answer your questions right away. Because let's be honest, talking about numbers and finances is not always very interesting. All right, so skipping over the slides all right, so business finance basics, so we're gonna start there. So essentials for maintaining your business. This is just accounting business aside, just regular business. It's super important to have insurance for a business. If you're starting a business and you don't have insurance, you're kind of setting yourself up for struggle down the road. And because insurance, there's so many different types of insurance. Here are a few additional, or general liability, that's just for your general business. Property, if you own personal property like laptops or equipment, maybe you own a building, all of those property, business income. So let's say when I first created this list, it was basically during COVID. So Business income insurance is if something catastrophic happens to your business and you can't keep your doors open or you can't provide the services. Business insurance business income insurance can pay you out for those lost earnings. Professional liability, that's if you are in a profession, you're providing services, and you're using your professional license to do those services. That helps a little bit protection on that. And errors and omissions, if you're doing accounting like I do, errors and omissions is crucial, because errors and omissions is if I inadvertently forget to add a decimal point on a deposit, for example, and now instead of depositing $100, I tried to deposit $10,000. That is an error that could potentially be helped or fixed with errors and omissions insurance. So if you're doing anything with numbers, providing a service of that nature, I highly recommend getting that. Obviously, you need a business license to have a business in Washington. If you're in Spokane County, you have to have a business license regardless. No matter if you earn $5 or if you earn $5 million, a business license is required. If you, again, professional, you need a professional license. So if you're maybe a licensed plumber, you have to be licensed to be a plumber, right? You have to have that professional license. I have to have a license for my CPA is my professional license. And then continuing education. If you have a professional license, I would always recommend learning more about the industry that you're in, regardless of if you're providing a service or if you have goods or you're selling product. Educate yourself on your industry, educate yourself on rules, educate yourself on laws. For example, accounting, tax law changes all the time. Every single year I take an update tax class, because every single year there's always a tweak, whether it's something sunsetting or something new. I mean, the last major tax law was the Jobs and Tax Act of 2017, so it's been a little while, but a lot of those things are actually sunsetting in 2025 until they do another update. So look to have a new tax update by the end of this year, most likely, to either extend some of those or just completely change it like they did in 2017. That's just a little fun fact. Let's see. There we go. Here are some foundational items. So when you have a business, it is imperative, whether you are a sole proprietor or you are a corporation, have a business bank account. Get an EIN number in your business name. Even if your business is your own personal name, you don't have to get employees. You don't have to have employees to get an EIN number. EIN is your employer identification number with IRS. It's free to get. But why do I recommend that? For one, because you can get a business bank account in your EIN number. Two, it helps distinguish your personal social security number from your business. So if you're having to send out 1099s or you're having to issue tax forms, you don't have to put your social security number on that tax form. That's one of the misconceptions, is that you have to have employees in order to get an EIN number. That's not true. Get it for your business, for sure. So starting out, get your business license, get your entity structure, which I'll go over a little bit, and then you get your business bank account. You can also get business credit cards and lines of credit or business loans. If you are buying a business, let's say you're buying somebody else's business. We bought a business at one point that was one of those paint and sip kind of things. The business no longer is in operation. COVID killed it, but we bought it, right? So we had to have a business loan to be able to buy this business. Sometimes it works out, sometimes it doesn't. But business loans, a great source of business loan, and Robin probably has a great resource of like where to go. SBA loans are pretty good for, which is Small Business Administration, Who knows with the changes in the administration we have, if that's going to be changes, but that's a good place to start because they have fairly low interest. You don't have to have collateral, and they're longer term loans. But you do have to have good credit. Credit is important in business and personal. And then, so that's the banking side of things. Record keeping is so important to keep your records straight. Whether you are knowing how much product to buy or make or produce to sell, whether you need to know how much you sold in January versus February, whether you need to know how much employees cost in January versus February, or maybe 2023 versus 2024 or 2025. It's so important to keep records. For the IRS, they are allowed to audit you for up to 3 years. So I would recommend keeping receipts, keeping any sort of accounting record for a minimum of 3 years. And that 3 years is from the filing of your tax return. So let's say you did not file your tax return right away, and in 2025, you're filing your 2022 or 2021 tax return, and you're filing 2 or 3 of them at the same time. That statute of limitations starts when you file it. So even if I filed 2021 this year, I have 3 more years for it to potentially be audited by the IRS. So that's something to be considered, extensions included. So it's when you file that tax return. So if you file that tax return right, on March 15th or April 15th, that's when your statute of limitation starts. If you have a nonprofit, the statute of limitations is the same, except for if you are missing a schedule at all that you are supposed to have, it does not expire. You have to dot all your I's, cross your T's, have every single schedule you're supposed to have with your 990. Otherwise, a nonprofit can be audited indefinitely. So that's something to consider. Let's see, so different types of keeping records. You can use Excel spreadsheets. I wouldn't recommend it. I mean, you're just starting out. You might have, a few transactions a month. It's a great way to organize yourself. It's not a good way to analyze yourself, if that makes sense. So maybe start, with your startup costs, you put on an Excel spreadsheet. Switch to an accounting software. There are so many different options out there for accounting software. There's even free options if you don't have a lot of money. I highly recommend cloud-based because you can access it anywhere. If your computer dies or crashes, it's not saved on one place. You can access it the same time as your accountant, for example. There's so many clients that I'll have, they'll call me up and be like, Amber, I don't know how to do this. How do I enter this in QuickBooks, or how do I enter this in this system? And we'll go into the system at the same time, and I will walk them through how to fix something, or how to add something, or how to correct something. So it's really helpful to have cloud-based. You also need those records to get loans. So if you're trying to get a business loan, or even a credit card for that matter, you need financial statements, you need balance sheet, you need profit and loss, you need tax returns, all to be able to get loans. And then you also need it for projections. If you want to have a successful business, if you want to have longevity in your business, you need to be able to predict. And you don't have to predict accurately, but you have to predict, you have to have expectations, you have to have goals for yourself. What does that mean? It means that you create a budget. You say, so if I'm sitting down with somebody starting a food truck, let's say, they're brand new, they're just starting out, maybe they have the truck, but they don't have anything else. So then I'll sit down with them, I'm like, okay, well, how much does it cost to make a pizza? How much does it cost to make a hamburger? How much, whatever they're selling, right? So we come up with costs per item. Then we say, okay, well, how much do you sell? Where are you gonna go? Is your food truck open at a certain location every day? Or are you going around to, let's say, farmers markets and events, and maybe you're only working on weekends because you have a day job. So then, okay, so you're only working 2 days a week on this food truck, you're selling at from, let's say, 6 hours a day. And then you then calculate, okay, I think I'm going to sell 100 hamburgers a day, twice a week. I'm going to do it every single weekend, so that's 52 weeks out of a year. You multiply those out to come up with what you think your gross income is going to be. And then you're like, okay, well, if I'm going to have this much gross income, I'm going to have this much cost of goods sold, which is the expenses that go directly into the product. So if you're selling a hamburger, the bun, the burger, the cheese, the lettuce, the condiments, those are all part of the product that you're selling. That's called cost of goods sold. So if I'm selling 100 hamburgers, I know, let's say it's gonna make me $100 just to make it easy. I know they're not a dollar each, but, and then let's say it costs me 50 cents to make it. So now, you might have sold 100 and made $100, but you really only made 50 after the product that you sold. So knowing the correlation between your prices and the cost of making those goods helps you plan for the future. Maybe you only want to work 1 day a weekend, or maybe you want to work 2 weekends a year or a month. And so you do a budget, you create and say, okay, in order to pay for itself, or in order to pay for all of these costs that I have, I need to make this much money. Well, maybe I'm not going to be able to make this much money by only doing two weekends a month. Maybe I have to do 4 weekends a month just to make enough money to be able to pay for my costs. And then obviously sticking with your budget. Things happen. One thing I would always encourage is adding a contingency into a budget, because no matter how accurate your budget is or how much you know what you spend, there's always going to be something that you did not expect. I mean, I've been doing budgets for almost 20 years now. I still come up with things that I don't expect, especially if I'm not the one doing the spending. And then, of course, budgets also helps with cash flow. Many businesses are cyclical, which means that maybe let's take childcare, for example. Also not something I'm very familiar with. Let's say it's a childcare that gets state funding. So the kids that go to the childcare are on DSHS, they get state assistance. You get paid at the beginning of the month for the entire month before. So that means you get this net influx of funds at the very beginning of the month that has to pay for payroll maybe twice, has to pay for rent, it has to pay for everything for the rest of the month. So just because I got this influx at the beginning of the month, I need to make sure it's gonna last for the rest of the month, right? So that's like cyclical. Or maybe you have a construction business that you do landscaping. In the wintertime, there's not a lot to do with landscaping, right? So you're probably gonna have quite a bit of dip in the winter, and then you're gonna probably get crazy busy in the summertime. So that's another cyclical where you have to plan for that time where you're not making money with the time that you are making money. So that also helps determine when you start a business too. If you're starting a landscaping business, it might not be a good idea to start it at Christmas. I mean, so great to plan, great to prepare, but maybe wait until it's time to start your sprinklers again. And then you focus on that. And then you focus on maybe, basing it off of the weather that obviously that you can work. So knowing your industry is also super important, and like what happens in your industry. Let's see. So then, okay, so you've got your industry, you've got your ideas. You also have to choose a method of accounting. Now, I'll tell you right now, most businesses, most micro businesses that Robin mentioned, is gonna be cash. And I wouldn't even do anything else, possibly modified cash. But what does this mean? Cash means that if you receive the money, you pick it up as income, you expense the money, you get it as a deduction right then and there. That's the time you do. Accrual is where I invoice. So I invoice for my services. I invoice usually the month after, right? I create a bunch of invoices, especially when you have a professional business where you're invoicing for your services and you're not getting paid right away, you usually carry an accounts receivable balance. So at any given time, maybe I have anywhere from $10,000 to $40,000 that I'm still trying to collect. Accrual basis says I have to count that as income because I've already earned it, whether I received it or not. So I might have to pay taxes on money that I haven't received. The flip side of that is if you incurred an expense, whether you paid it or not, you still get to have that expense. So payroll, for example, is a great one where, let's say the end of the pay period is December 31st, but they don't get paid until the 5th or the 6th of January. Accrual says I can expense that last year. Cash says I have to expense that this year. Modified cash is like something in between where I have a client who, childcare again, they do automatic payments the day before the month that it is incurred. So that means they get paid basically for the month of January on December 31st. Well, they don't want to pick that up as income because they haven't had all the expenses to offset that income yet. So they're on modified cash where they just have that as deferred income, and then they don't have to pick it up as taxable until the same time that they have those expenses. And tax just means tax is mostly cash, but you're following tax laws. So depreciation has differences in depreciation. You're using makers instead of like straight line. I won't necessarily go into all that. You can get a tax professional to help with if you're doing depreciation. GAAP is generally accepted accounting principles in the United States of America. It follows accrual for the most part. So big corporations are required to be on GAAP. They're required to be on accrual. But if you're making lots of money, you're required, even with tax, to be accrual basis. When I say lots of money, I'm talking, I don't know what the limit is right now, but I want to say it's grossing $10 million, right around there. I'd have to look it up, the exact amount, but it's a while. Let's see.
Amber, question.
Yes.
So if I choose one, cash, because that's easiest and it's easiest to track and it makes the most sense because I'm going to be taxed on money I've actually received, can I later switch to a different kind?
You can. It is a slightly complicated process, more so for tax purposes, because you essentially have to go back in time and see if I were accrual during this whole time, what would my net income and my retained earnings been at that time? And you'll have to do like a prior period, either clawback or deduction or something. So you have to do, highly recommend getting an accountant for that to do all those calculations. But it is very possible and it is very doable. And in fact, the IRS requires you to if your income gets to a certain amount. So, but I wouldn't recommend doing it regularly. Don't be going back and forth. Be strategic with it. I always tell people start with cash and go from there. It's a lot easier to switch to accrual than going backwards. And for the most part, accrual is not going to benefit most people, especially a small business. A sole proprietor where you have a Schedule C, yes, you can do accrual, but it's automatically cash unless otherwise noted. So a regular taxpayer, like when you get a W-2, it's on a cash basis, right? You got the money during a year, that's what you're taxed on for W-2 purposes. It doesn't matter when that pay period was. So, let's see. I also highly recommend establishing internal controls. What does that mean in accounting world? It means that you have practices, policies in place to either prevent an employee from stealing from you, maybe preventing you losing a receipt, preventing your forgetting to collect on an invoice that you sent to a customer. So internal controls are to help, are basically a checklist, something that you can implement every single time so that you don't forget things, or you don't misplace things, or you don't have employees who have more power or more control than you realize that they do, and they're taking inventory or they're taking cash. So these are some examples. Separation of duties. What does that mean? It means that the person depositing money in the bank is not the same person writing a check. Or maybe the person writing the check is not the same person who has access to the bank that does the reconciliations. So you're separating out, and yes, it's hard to do as a individual. If you are it, and there's no separation you can do. But then again, if you are your sole employee, you are your sole person, it's all your money anyway. You'd be stealing from yourself. So create financial policies. I always recommend creating financial policies, and employee handbooks, policies are pretty much required, regardless. I mean, ask any lawyer, and that's kind of a no-brainer. Especially L&I will also tell you that it's basically your contract with your employees. Any dispute you have with an employee, it goes back to the handbook. And the handbook is basically like the law, if you will, for that dispute. Obviously, the handbook itself has to follow laws, employment laws. We always get our employee handbook just reviewed by a lawyer, an employment lawyer. We write it, we do it all, but we have her look at it every year just to make sure if there's any law changes that happened or any tweaks that need to happen, that it's current and it meets standard law. Because that's not something I keep up on. But financial policies are the same thing. Nonprofits especially have to have financial policies. You have to, because ultimately with a nonprofit, the board is responsible for the finances of a nonprofit. If your executive director has authority to do everything and anything and makes all these decisions, and maybe they mess something up, maybe they steal, maybe they're just not capable in their capacity, the board is responsible for that. So if somebody is wronged or somebody sues a nonprofit, the board could potentially be liable. It's another reason why I recommend board insurance. But that's something as an example. So financial policies help prevent that. So it says, okay, an executive director, for example, has the authority to spend $5,000, but anything over that has to be approved by the board president or signed by the board president or something like that. And that's what gets depreciated at what cost is a financial policy. Who reconciles versus who runs payroll. Those are all part of financial policies. Keeping clean and thorough records. Uploading receipts to a cloud. If you use an accounting software like QuickBooks, you can upload your receipts directly to it. SIMBA uses Dex, and they upload all of their receipts to this software, Dex, which is amazing. I actually love it. It's probably not cheap, but but it's amazing software. It's been very helpful. But having some place to store those receipts, especially receipts nowadays, are usually laser printed. And I don't know if you've ever had a laser printed receipt in the sun for any length of time. It might potentially go away. It gets destroyed. The sun will basically laser print the entire thing. So I always like to scan receipts as soon as possible, if I can, if I have the capacity. And for one, it's so hard to keep track of receipts and where they are, unless you're filing them immediately, which, let's be honest, most of the spending you do, you're running around in your car, you grab the receipt, you put it maybe in your glove box or something like that, out of sight, out of mind. It's hard to keep those receipts. So the sooner, the easier you have them. Like even if I go to like Lowe's, I'll have them email me a receipt. I don't even have them printed. I want it emailed so that way it's already electronic. I can search, I can store it. That's partially me because I just know myself and I prefer electronic, but that's a good point. Know yourself. Know exactly what you do and what you're capable of. Like if you know that you automatically give a receipt to the dog, for example, and it goes away, then plan accordingly. Make sure you upload it. Maybe you take a picture of it. Sometimes I'll take pictures of receipts. I almost always take pictures of deposits because those are harder to track. Like if I deposit multiple checks at the same time, you can get that information from the bank, but not if you log in. You have to actually call them and be like, okay, what did I deposit this day? So I take pictures of my deposits as my deposit slip to make it easier. That's just a little trick that I do. You certainly don't have to, but the biggest thing is always review your financial data. So having that accounting software will allow you to look at it. How did we do last month? How did we do 2 months ago? I have a client who I print out, childcare again, right? So tight margins. So I give him a projection of what the next month is going to be, along with the actuals of like the last 5 months. And I give it to him in a spreadsheet so that he can compare and he can contrast. And like maybe they spent an extra couple of $1,000s on continuing education. Well, why'd we do that? Well, because it was the end of the year and you had to get your STARS hours, right? There's so many different things that can go into it. So always analyzing that. You can do it on a monthly basis. You can do it on a quarterly basis. You can do it on an annual basis. But always take a look. The easiest, when you have it on an accounting software, you can compare it. Comparing and contrasting is one of the best analytical tools you can have from a financial standpoint. And then, of course, budgeting and sticking with your budgets as well. Let's see. And then time tracking. I don't know how many times I've been told, well, I own the business. I pay myself when I can. I don't track my time. I just constantly working. Maybe I work 50 hours a week. Maybe I work 80. I said, track it. And the reason is because you need to know, there's only one of you, right? If you need to hire an employee to take over your responsibilities or some of your responsibilities, how are you going to know how much time it's going to take them if you don't know how much time it takes you? So even though you might not be paying yourself for your time, you need to know how much of your time is worth it. If it takes 80 hours to crochet a blanket, but you can only sell it for like $30, is that 80 hours really worth it? I mean, so like you have to like your time is money. Your time is valuable as well. So just because you're not being paid like a normal employee does not mean that you shouldn't factor that in. But obviously employee time too. Track employee time, particularly if you're audit employee time too. What does that mean? It means that if Sally says she worked 40 hours, does she really work 40 hours? Maybe you notice that she always goes home 30 minutes early every single day, but her timesheet says she's always there full time. Well, that's something you don't know until you can track it, improve it, record it, and track it. That Washington is an at-will state. You could fire Sally whether you wanted to, like for anything, but having that documentation helps support firing somebody. Maybe Sally works 50 hours a week and she only says she works 40. Well, that is also an L&I breach. You're supposed to pay her for those 50 hours, provided she's not salaried. We're not going there right now. And so you'll need to sit down and have that discussion with Sally and be like, I noticed you're working 50 hours. I want to and need to be able to pay you for that. I need you to track your time and tell me how much you truly are working, right? Because what if Sally has only been getting paid for 40 hours, she's been working 50, she hasn't been telling you she's been working 50, and then she quits, she's disgruntled, she goes to L&I and says, I've been working 50 hours a week for 6 months and they haven't been paying me for it. Washington is very much on the side of employees without documentation. So they will side with her more than they will with you without any of that proof. And if they side with her that she worked 50 hours a week for 6 months, you now owe her all this back pay, all these back taxes. And let me tell you, the penalties on not paying payroll taxes on time are very steep. Very steep. That's one thing that I would not mess with, payroll taxes. So the last thing you want to do is not pay somebody for their time or anything like that. So it's so important.
And I think jumping in there, one of the penalties is you owe people double what you were supposed to pay them, plus interest in the state of Washington. And it's double at that overtime rate, and they do not play about. And if you have not kept records as the employer and audited them, they presume everything the employee is saying is correct because you haven't done your job. So Amber is correct. Track and audit that time. There is a software app, not for employees, but for yourself, that I would use for yourself as a small business. It's called Clockify. It's free. You can use it to create invoices, but you can also use it to just track your time, so you know actually how much time you're spending as a small business owner. So Amber's right. When you're trying to hire, how many hours do I actually do my job, and what can I pay them, and what do I need them to do?
And one thing that we always we do is have employees sign timesheets. So we'll print the timesheets out, have them look at it. If they have any discrepancies, if they have any issues with it, then they can change it right then and there, and we let them sign it. Yeah.
So I have somebody that's 1099 for me, and they just get a flat rate each month. I just pay them.
That's different because they're not an employee.
Okay. So what should I be tracking for them or have in record? Because we don't really, it's kind of just like, you know.
So for a 1099 contractor, I'm not even going to call them an employee, that is supposed to be project based. So meaning like contract based, so contract specific. So if you're hiring them for a specific purpose, a contract, typically they're somewhat finite. I mean, so I'm a contractor for SIMBA, right? I'm not an employee. So they pay me for ongoing services, but we do a new contract every year. And we say, this is the expectations. So one, I would recommend doing that if you don't. And then in that contract, you can state, I'll pay you this much money per month, and these are the expectations I have out of that money. You are not allowed to dictate how many hours it takes them to do that. Maybe it takes 1, maybe it takes 50. You're not allowed to dictate when they do that. So you're not, if you require them to be at your store, you know, from 8 to 5, that's an employee, not a contractor. So a contractor is basically a self-employed individual who has autonomy over when, how, where they provide that service, but you can hold them up to the expectation of, you said you were going to do these things for me. If you don't do these things for me, then we won't be able to do business together.
Okay, thank you. So just make sure that I have a good contract with deliverables. That's it.
Yeah.
Okay.
And also invoices. The contractor has to invoice you.
Yeah,
every
you don't
month.
have to pay them anything without them giving
That's
you
right.
an invoice. I would recommend it, because then again, so what happens? You have a contractor. Maybe they have a contract. You're paying them monthly, a regular flat fee, and maybe you are or not checking those deliverables. What if they get disgruntled? Again, they go to L&I and say, I'm an employee. I shouldn't have been paid as a contractor. I'm sick of paying these self-employment taxes. Now, the burden of proof is on you to prove as the employer that they shouldn't have been an employee. And if one of the things that helps you is having that invoice saying, hey, look, they invoiced me for their time. But if instead of paying them like a salary, because just a regular interval of money could potentially be viewed as a salary. So, and again, like I said, Washington State is very employee friendly. So yeah, contractors, that you definitely have all of those measures in place. But yeah, as far as their time tracking, that's on them. If they want to see how much time it takes them to do it, You know, they can come back to you and be like, you know what, this $1,000 a month that you're giving me is just not enough because I spend this much time. Then you can renegotiate your contract. But I would definitely discourage doing those contracts at a per hour basis, per se. It's a little bit different for like a professional. Like I charge per hour, but not at my, in like how much I pay myself, right? So it is at an hourly basis, but I set exactly how much, you know, and I set like the time that I do it. They just expect to have financials when they want them, right? When they need them. So, but if you have an almost perceived employee, and I would definitely, especially if you're paying in the ballpark of like $17 to $25 an hour, that's an employee type wage range. And so it's easier to kind of argue that that's an employee. But if you say, I'm paying you $1,000 a month for this product, maybe it takes you an hour, maybe it takes you 50. That's up to you and your own and them.
I'm bringing you the mic.
Oh, geez.
For recording, of course.
How would a contractor work if you hire them for an event, say? Like just a one-off, and you're saying, okay, you're gonna work this event, I'll pay you $400 for the event.
That's a little bit easier because it's a one event.
Because it's the same way though, right? It's
yeah.
Okay,
And you can hire someone for an event and be like, you know, I just need extra help. You know, it's under the table, but it's not, right? I mean, because obviously you want to do it right, have a contractor, have a contract for them, and you can just be like, I'll pay you $100 a day or $150 a day or something, and whether they're there 8 hours or 5 hours or whatever, you can have the expectation that the booth has to be manned at all times by somebody for this time period, that kind of thing. All right. Let's see. Here's a couple of common mistakes. All right, so that doesn't explain very much. Keep completely separate. What I mean by that is banks. Make sure you're not using your personal bank account for business expenses and not your business bank account for personal expenses. It is so easy for a small business owner to go get that business bank account. Like they do that separation, but then they use it for everything. They put their home mortgage on there. They put their property taxes on there. They put their health insurance on there. They put their kids' school on there. And then pay it directly out of the business account instead of their personal account. That commingles the separation of like liability. So if you're commingling your funds, even if you have a corporation, which is the best liability protections you have, if you are using that corporation for personal expenses, I mean, well, that's actually worse than a sole proprietor, but because there's like fraud, legal issues on that side. But if you're using that business for personal expenses, you pop that veil, that liability veil. So if somebody sues your business and you have your mortgage on, you're paying it directly out of your business, they could go after your house because you could argue that business owns the house. Maybe not legally, but it's paying for it.
I have a question.
Yeah.
So I have a business account that I keep, all my business stuff is there, but occasionally I will purchase something from my personal account for my business. Mm-hmm. Is there a way to do that, or should I be putting more investment into my business and then make the purchase through the...
In an ideal world, I would recommend putting more investment into your business.
Okay.
And paying for things out of your business.
Okay.
In a practical world, yes, that happens.
Okay.
And it's better paying for business expenses personally than it is paying personal expenses from a business account.
Right, okay.
But I would recommend depositing money into your business account. The biggest thing though is if you do that, make sure you don't treat it as income.
Yeah.
Because the last thing you want to do is pay taxes on money you put in your business yourself.
Right, okay. Thank you.
So record keeping, again, I can't stress enough, accounting software, record keeping, keep your receipts. There's been businesses for years be like, oh, I never keep my receipts, I'm fine, I've never done that, like I've never had, until that one time it's not fine. Right? Like they might have been able to get away with it for maybe even for 5-10 years, but until all of a sudden they get that audit and now they don't have anything to prove or to show, or maybe they get sued by somebody and you can't produce that receipt, or an employee, you can't produce that time card. I mean, records is what's gonna save you every time. Audit, lawsuit, any sort of liability protections, records. And keeping them in a way where you can access them. For example, I have a whole bunch of tools in my garage. They are completely unorganized and I have no idea where anything is. Yes, I have them, but they're not useful to me if I don't know that I have them because they're not organized, right? Same goes for financial data, for receipts, for bank statements, anything like that. If you don't know where to find them, have an organization system somehow, having it doesn't always matter. A shoebox full of receipts is still a shoebox full of receipts. It's still gonna take hours to go through and sort and organize to be able to find what you need. Okay. All right, so now I'm gonna go and talk about business entity types. So these are the 5, because CNS are kind of together, but types of entities. Sole proprietorship, that's where I just want to get a business license. I want to go, you get a business license underneath your social security number. You are your business. You are, like, it doesn't matter if you use your personal account for your business or your business for your personal at that point, because there's no separation between you and your business at all as a sole proprietor. I tend to not recommend people do that unless, so for example, I had a client who had a vending machine. It was in a place, it hardly ever got used. She made probably $500 a year on it at most. Might not be worth getting an LLC, spending $500 to, receive $500 for the year. That, I'm like, yeah, keep it as a sole proprietor, that's fine. But that's probably like the only type of example that I would do that. It's also easier for the IRS to view your business as a hobby if you have a sole proprietorship versus like an LLC or another structure. What does it mean if the IRS says that your business is a hobby? It means that any losses that you might incur from your business, the IRS will completely disallow. And they say, you're just doing this for fun, you're not doing this to earn money, therefore you don't get these as deductions. That's what that means. Partnership, so there's LLPs, which is limited liability partnerships. It's a partnership with limited liability company protections. Joint ventures is where it's basically a sole proprietorship with somebody else. So a joint venture is where you have an agreement, but you don't actually have an entity. And you have an agreement with somebody, and I'll take, maybe it's a 50-50 agreement. I do 50-50 on my tax return, you do 50% on your tax return, and we call it good. But there's no actual like business entity. So partnerships and joint ventures are kind of the same, very similar. A limited liability company, this is the one that I probably recommend for anyone truly starting out a business, is starting it out as a limited liability company. Why? Because limited liability companies are the most flexible with the most amount of liability protection within that flexibility. Obviously corporations, C corporations particularly, have the best liability protections, but they also have the most rigid tax structure, and they have something called double taxation, which means with a C Corp, if you want money to come out of the corporation, unless you're paying yourself it as wages, it will be double taxed, meaning the corporation doesn't, if you take distributions as an owner of a C Corp. Those distributions are called dividends. You have to pick them up on your tax return as a dividend. The corporation does not get to deduct them. So therefore, the corporation has to pay taxes, even though you took the money out, and you have to pay taxes because you received the money. An S Corp, distributions are non-taxable. Why are they non-taxable? Because S Corp money gets taxed on your tax return, on your personal tax return. So you get something called a K-1. I call it the equivalent. It's basically the W-2 for a business owner, in the sense that it's all of the income that you earned in the business, whether you receive the money or not. It doesn't matter. If the business earned it, it gets put on a K-1. It gets put on your personal tax return, and you pick up the income. So because you pick up the income, regardless of if you take the money or not, you can take the money without being taxed on it. That's S Corp level or lower, if you will. Going back to a limited liability company, one of the reasons why I like it, limited liability company, if it's a single member limited liability company, LLC, it's treated like a sole proprietorship with liability protections. So it gets put on your Schedule C on your personal tax return. So it's taxed on your personal tax return. You cannot file your personal tax return with a W-2 and then want to file your business later. They are one and the same. So you have to have your business income on your personal tax return. So as I mentioned, a single member LLC treated as a sole proprietorship. You can elect to make it an S Corp. So you can take that same exact entity structure and make it an S Corp with the IRS without actually becoming a corporation first. That being said, if you have a limited liability company, you made it an S Corp. If you lose your S Corp status, meaning the IRS said, no, you can't be an S Corp anymore, or you choose to forego your S Corp status, it is now a corporation. It cannot drop down to like a single member LLC anymore. It's a corporation. So keep that in mind because a lot of people will be like, oh, I don't have to pay self-employment taxes on an S Corp, therefore I want to be an S Corp immediately. I would not recommend that. The reason being is because S Corps, because it is a corporation, has more rules, has more structure, has basis limitations, has requirements that you have to meet to keep that S election. If you don't meet those requirements, you now are a corporation subject to double taxation. So when the times that I recommend people changing to an S Corp is when their income, they see a steady stream, meaning like you have a projection, you see it in the numbers, you see you're continually rising, you're going to be continue to make more and more money, you don't really foresee a downfall of some kind. Maybe you expanded into another building, and you're just continuing to see that rise. At that point, that's where I would probably look into becoming an S Corp. To be an S Corp, as an owner, you have to give yourself W-2 wages. It's called reasonable compensation, is what the IRS calls it. If you do not give yourself reasonable compensation as an S Corp owner, you will lose your S Corp status. Reasonable compensation, what does that mean? It means whatever the industry you are in, whatever you would pay an employee to have basically the same job as you, that's what you need to be paying yourself.
Amber, you keep talking about liability protections.
Yes.
Tell me what you mean.
Liability protections means if your company gets sued or your company, going back to those errors and omissions, for example, your company makes a huge mistake or something, and your client, or maybe Sally who fell at a construction site, sues you. Liability protection protects your personal assets from being seized or potentially part of that lawsuit. So like my personal house is not going to be subject to this lawsuit if my business is in trouble. Or maybe the business goes into bankruptcy. Maybe you can't pay your debts and the business goes bankrupt. It doesn't take your personal assets into that bankruptcy filing because of that liability protection.
Good. Except for wages. You cannot get bankruptcy protection for wages. So if you owe someone money, you're always liable to owe them money as an employee.
Yes. Or trust accounting, meaning if you are holding money on behalf of somebody. So for instance, when you collect sales tax on behalf of your customer, that money is not yours. It is actually the state of Washington. You are just collecting it on behalf of the customer. And therefore you have to give that money to the state of Washington because it's sales tax. So you're holding that in trust. It's not technically your money, but you have it in your bank account. That will always have to be paid to who you're supposed to pay it for. Lawyers have trust accounts where they actually hold their client's money, or maybe their client makes a settlement, the money goes to the attorney. That money has to be given out to the client. There's no ifs, ands, or buts about that. Payroll taxes is a huge one. So when you have employees, you withhold federal withholding, you withhold Social Security, you withhold Medicare, for example. Once you withhold that from their check, they're taxed on that money because that's part of their gross wages, but you're holding on to it. It's no longer your money because they've earned it. If you don't pay it to the agency, the IRS or the state of Washington or whoever you're holding it for, you can get into some serious trouble. And that's why I mentioned payroll taxes have very steep penalties because the IRS does not play around. Really. Let's see. So going back to if you have the funds, if you're expecting your business to do enough, I would recommend starting with a limited liability company, keeping it at a little limited liability company. If you have 2 or more owners that are not married, a limited liability company is automatically a partnership and files a partnership tax return. If the 2 owners of the limited liability company are married, you're considered one person and it jumps to a sole proprietorship as being a disregarded single member LLC. Yeah. It's also a lot easier for estate planning as well as planning for your future in a LLC or a corporation because, maybe you might have heard of a family LLC before, where there's a family-owned business, or maybe it's just a family-owned lake home, right? That grandma and grandpa owned this lake home and they want their kids or their grandkids to have it. And instead of waiting for them to die and then inheriting it, they put it in this LLC. And it is a lot easier to buy, sell, gift shares of or units of an LLC, shares of a corporation, to other people than it is to sell a business. You can sell part of an LLC. You can sell entirely. If you have a sole proprietorship, if you want to sell a business, it's kind of hard to sell half a business. Maybe you can, but it's a little bit harder to do. Usually you just start a new business and you bring in your assets and they bring in theirs. But if you have an LLC, maybe it's a successful business, somebody wants to come in and be a business partner, you can get a valuation, they can buy a portion, maybe it's 5%, maybe it's 10%. At accounting firms, it's not uncommon to have partners come up and buy into the firm, right? So they, more often than not, in the partnership agreement or the LLC agreement, they will have a buyout option. They'll have a purchase price and be like, if you want to buy into this company, you have to pay $10,000 per unit, per share, or something like that. And they set that price. And it's a lot easier to gift those to kids or grandkids. It's a lot easier to sell in that type of structure. So, okay. And so these are just the tax implications of it. So sole proprietorships, I'm not sure why partners got down on the bottom, but both of those are subject to self-employment taxes. What are self-employment taxes? Self-employment taxes are Social Security and Medicare taxes. Because when you are a partnership or a sole proprietor, you're not getting W-2 wages. You're actually not allowed to give yourself W-2 wages, FYI. So if you have a sole proprietorship that you're giving yourself W-2 wages, that's actually illegal. But you give yourself guaranteed payments as a partner that's similar to wages, but the taxes are still paid on the tax, your personal tax return instead of within the business.
I have a question from the Zoom.
Yeah.
Have you ever heard of a bigger business that is still an LLC, like a chain?
Yeah, I mean, they're still LLCs, but they're usually have become an S corp. Or you could even be an LLC and be taxed as a corporation as well. So you could start as an LLC and then just work up that liability ladder, for lack of a better word. But so going back to the tax structure, so partnerships, sole proprietors, subject to self-employment tax, 15.3%, which is employer and employee portions of Medicare and Social Security. That is automatic tax on top of your regular income tax. S corps, not subject to self-employment taxes, but the income is still picked up on your personal tax return. And the reason why the IRS allows that is because you're required to pay yourself those wages, those reasonable compensation wages. It's very subjective what reasonable compensation is, so I always use that with a grain of salt, but that's what the law says. And then corporations, again, pays their own tax. So the corporation income does not flow through to your personal tax return. It files its tax return, it pays its own taxes, but it can pay you wages, it can pay you dividends, both of which are taxed on your personal tax return. So that's why, like, if you own stock, let's say you own Microsoft stock or something like that, and they pay out dividends, that's the same thing. They're giving you a distribution for being an owner of that company. All right. So tax planning. All right. Let's see. It's so important to know what you're allowed to do. As far as what you're allowed to deduct, what you're not allowed to deduct, what you're allowed to charge, what you're not allowed to charge. Like, for instance, income taxes, the amount you pay for income taxes will never be a deduction for income taxes. You have to pay them, obviously, but they're considered distributions to yourself or money you took personally. It can never be. Even a corporation who pays its own taxes cannot deduct income taxes as an expense. So knowing that, knowing the laws that changed. So like I mentioned, the Jobs and Tax Act was the last large tax law change. And there were quite a bit of changes. It dropped the corporate tax rate down to 21%, added the UBI deduction. It eliminated entertainment and meals and entertainment expenses. So you were no longer allowed to deduct any meals that you paid for. It eliminated parking. You're no longer allowed to deduct parking from your even if you're parking for a business purpose. Meals have been clawed back a little bit. Entertainment, not so much. Parking, not so much. But meals, you're allowed to pay. If you take a client out to a restaurant, you're trying to solicit their business, right? You are allowed to deduct what you pay for them, not for what you pay for yourself. So, and that one I feel like it changes every year. but knowing that, right? Not knowing what you're allowed to deduct. And that's why I highly recommend getting a tax professional. It does not have to be me by any means, but I am available. But getting someone who knows that law. Like I said, I take at least one tax update class every single year because every single year there's changes. Unless you want to take a tax update class every single year, I recommend finding someone who does, right? And then obviously, okay, so tax planning. So tax planning, for me it's fun, right? So every single year, December, November time, I'll get phone calls from clients and being like, okay, I have $100,000 this year. What do I need to do to get my tax burden down? What do I need to do? Or how much do I need to pay in so that I'm not surprised with a $10,000 bill in April, right? So we go over different strategies. One of those strategies is buying year-end investments, meaning, let's say you're a contractor. You made $100,000. You need to get a new excavator because yours is going on the fritz. Do I get that excavator in December, or do I get that excavator in January? Maybe I made $100,000 this year, so maybe I want to buy that excavator this year. Maybe I have a loss this year, but I know I'm going to have some income next year. I'm going to wait till January to buy it because then I get more of a deduction in January or 2025 versus 2024, for example. That's one of the tax strategies that we use. Another tax strategy that I use is playing with wages. So if it's an S-Corp owner that comes to me, they've paid themselves a yearly salary or a monthly salary. So at the end of the year, I say, okay, well, you're going to owe $10,000 worth of taxes unless you pay something in. So in order to limit the underpayment penalties for not paying that in throughout the year, we give them a bonus of, let's say, $15,000 at the end of the year, make $10,000 of that federal withholding, and now they just paid in an extra $10,000 to cover that $10,000 liability without any additional penalties or underpayment penalties. What are underpayment penalties? The IRS says if you do not pay in enough money at certain times of the year, you are subject to this underpayment penalty and you'll have to pay an additional tax. It's pretty small right now, but it can add up, and it's fun to avoid them. So as a small business owner who's not getting W-2 wages, it is important to do estimated tax payments to avoid those underpayment penalties. I have clients who refuse to pay estimated payments. They know they're going to get the penalties. They know that they're going to pay more taxes, but they tell me, Amber, I can make more money with my money now than paying it to the IRS. And it might cost me maybe $1,000 worth of penalties, but I just made $2,000 by investing in this client or in this thing. That is a choice that they make. It's not something that I tell them to do or recommend it, but I'm saying it as it is an option. It's your choice. You can choose to pay the taxes or not. It can really add up, and you need to be prepared to pay those taxes, because eventually you'll have to pay them regardless of when. Another tax planning strategy that we use is retirement. So if you have a retirement account in your business, there's multiple different retirement accounts. I don't have a slide for that, so we'll talk about them a little bit. So if you are a sole owner, sole employee, you're not planning on having any employees, but you make a decent amount of money, I would actually probably recommend a 401k solo. 401k solos, you can put in, I think it's up to like $55,000 into your retirement account without any additional repercussions in the sense that if you have a 401k plan while you have employees, you have to do top-heavy testing. You have to make sure that you as an owner don't put in more than your fair share than your employees do. So you have all these actuarial tests that need to happen, which is why if you have employees, but not, I don't recommend 401ks if you have less than 50 employees. The fees involved in a 401k are just not worth it. But a 401k solo, where you are your only person, those fees are minimal because you don't have to do all those extra testing, but you can still put in the maximum amount that a 401k allows you to put in. If you have employees, then I would probably go down to, it's not down, but I would go to an IRA, particularly a simple IRA, where you can put money into your retirement account, they can put money into their retirement account, and then you do a match. Safe harbor match is, I believe, 3%. Which means that you would have to match dollar for dollar what they put into their account up to 3% of their wages for the year. And it's calculated annually. The reason why retirement contributions are so helpful in tax planning is because you can make them after the year is over and still count them for the prior year. So you have, from an employer standpoint, you have until the tax return is filed, including extensions. So if you extend your tax return to October 15th, you have until October 15th to make that retirement plan contribution. So traditional IRAs are the same way, but traditional IRAs, you have a max of $6,000. Actually, it's plus catch-ups. So it's very limited. A simple IRA, I believe, is now $16,500. I should have probably looked up those numbers. That you can put into your retirement account, and then again, the employer match on top of that. But it's a great way, especially if you don't have any employees. You are your own, you are your business, right? You can use a retirement plan to reduce your tax liability. And the nice thing about a retirement plan is you're paying yourself. Yes, you cannot touch that money until your retirement age, but it's money in your own pocket. It's still, it's money down the road, but it's still yours, right? You're not paying those taxes to the IRS. But one thing I do tell clients is it's not dollar for dollar, right? If you're trying to avoid $10,000 worth of taxes, you might have to put $50,000 into an IRA. If you don't have $50,000, it's worth paying that $10,000 worth of taxes, because $10,000 is a lot less than 50, right? So don't ever make yourself cash poor just to avoid taxes. Don't go out and buy that fancy car to get a deduction on your tax return just to avoid taxes if you didn't need to spend the money on that fancy car. Because it's not dollar for dollar. Yes, it's fun to be creative with taxes, but one, be legal. And two, it's not a dollar for dollar. So always assess, even people who are putting money into their retirement account from their W-2, I say, well, how much can you comfortably live on? Take that aside, and then how much is left, and that's what you consider putting into your retirement account. If that much that's left is only $4,000 for the year, only put $4,000. You don't need to max out your retirement account if you can't live off of what's left right now. So that's planning. So uncollectible debts, fun fact, not a deduction on cash basis. So the majority of taxpayers, if you're cash basis, just because you can't collect what you billed your client does not mean you get to deduct it as an expense. The reason being is you never picked it up as income. If Sally owes you $1,000 and you're never going to collect it, you just write it off, but you can't have it as an expense because you never picked that $1,000 up as income. Accrual basis, you picked that up as income already, And that's why you get an uncollectible or bad debt expense. So if people ask you, questions I get all the time is, well, can I write off my inventory? Or can I write off my uncollectible income? Yes, you can write it off, but not as an actual expense on your tax return. Inventory is a different story though. You actually spent money on that. So therefore you have inventory you can't sell. Maybe you're gonna donate it. Maybe you're gonna just throw it away. That's a deduction because you actually spent money on it. But it's only a deduction when you can't use it anymore. So if it's still available for sale in your inventory, it's supposed to be inventory asset, a non-deduction. Once you've deemed it as obsolete, you can't sell it, there's no way, that's when you can actually deduct it. Or if you actually sell it, then of course you can deduct it at that time too. Let's see. So here are some common business deductions, and I did not compare this list to the one I gave you before. So there might be different things on here, more or less, but these are some helpful little things. So home office. Home office is a great tool to use to be able to expense some of your house, right? Some of your mortgage or your rent or your utilities. That being said, there are stipulations to having a home office. If you have a physical location, like an office that you can go to, you can't have a home office deduction as well. If you have a spare bedroom that you have a bed in that you use as a bedroom, but you also have your home office in it, that does not count as a home office. A home office has to be a designated space for the business. So if you have a spare room that you just have your office in and no spare bed, that doesn't mean you can't take the air mattress and put it in there when company comes like every once in a while. Like, it is what it is, right? But you need to have, if you use your counter at maybe your kitchen island, that does not count as designated office space. So it has to be a room where if somebody were to come in and be like, oh yeah, this is a home office, it's only used as a home office, and they can measure the room and everything like that, that's the only time that you can use a home office. But if you have a home office, you can deduct a % of your utilities, a % of your rents, a % of your repairs, your internet, and then of course office supplies. Even if you're using it at home, if it's office supplies that you're only using for business, you can deduct those fully. So that's aside from home office. Travel expenses, if you're traveling for work, you can do that. Phone and internet, business meals, startup costs. Startup costs, you can deduct the year that you start, or you can choose to amortize them, and that's an election with the IRS. If you make, I think it's less than $50,000 in, you can just deduct your startup costs. I would probably recommend just deducting them. If you have a lot of upfront costs, let's say you start your business in November and you have quite a bit of costs. Maybe you have some patent and trademark costs and legal costs and starting your business costs, and then you really start your operations in January. I would probably take all of those costs that were incurred in November and December and amortize them as startup costs to be the expense starting in the year that you actually start operations. But you can deduct startup costs. Legal and professional, automobile expenses. So I have some slides that I'll go, I'll get more into that. Banking fees and interest, and interest of time. I won't necessarily go over these. The one I will highlight though, qualified business income deduction, QBI, that is one of those, that's the expense that came out of the Jobs and Tax Act of 2017. And basically, because they made the corporate tax rate 21%, which was the lowest it had been in a really long time, they were afraid that all of these small businesses would all of a sudden become corporations to try to like save on taxes. So in order to prevent that, they did this QBI deduction, which is essentially 20% of your taxable business income as a deduction. No actual money needed, like no expense, money out of your hands. It's just a 20% of your taxable income.
And Amber, you cannot take that if you're a corporation, right?
Correct. You can take that as an S-Corp though, and it has to be on your personal tax return. There's of course limitations and a lot of rules involved in that. So consult your tax professional, but it's kind of a nice little help.
On phone and internet, what if I use my personal phone for business and personal? Can I deduct that?
You can. I would recommend doing a percentage.
Is there a percent that would be too high?
No. I mean, I would do a carve out for personal. Like, I use my cell phone for business and personal. Like, I just have one cell phone. I can't handle two. So, but if I'm being honest, probably 90% of my phone calls are business related. The other 10% are going to be kid related, or my daughter sending me Instagrams. But so I would probably deduct 90% of my cell phone. If you use your cell phone mostly personal and you're a weekend worker and you just use it, or maybe you have a day job and you use your cell phone for your day job and then you use it again for like your side hustle for the weekends, you probably use it more personally. Your day job is not considered business in this regard, and so it would be more personal. So really, really analyze how much you use it, because when in doubt, if you were to get audited, the IRS would like look at your call logs and be like, okay, what's personal, what's business? They see the same number very regularly and they can prove that's your kid's phone number, for example. They're gonna disallow that. So depends on how petty they can get very much into the nitty-gritty details. That being said, they are short on auditors, and so they do a lot of desk audits, which means pretty much they will send you a letter stating you're not allowed any of these expenses until you prove them. And then you have to send them documentation proof of those expenses, and then they'll add them back. And it'll all be not in person. So let's see. So tax plan, quarterly estimated payments. Like I mentioned before, you need to pay in your estimated tax payments to the IRS. It's so easy for somebody just starting out a business to not realize the tax implications and the taxes that are required on a new business. You make money, you no longer have an employer withholding taxes to pay on this income. So first things first, I would recommend having like a savings account that you just stash tax money into. So you make a certain amount per month. I'd stash at least 10%, if not up to 20%, into the tax account. One, you can use that for your sales tax as well. So to remit your sales tax so that you're not accidentally spending it. But also to pay your tax payments, because nothing hits harder than April 15th and a $20,000 IRS bill. And you'd be surprised how often that actually happens. So these are the dates that when estimated tax payments are due. April 15th is for the first quarter. June 15th, as you can see, that's only 2 months apart, not 3, is for the second quarter. September 15th is the third, and January 15th is the fourth quarter.
What if I have a day job and my business is my side gig? Do I need to be saving 20% if I'm only working on the weekends and making a small amount of money while I'm trying to get out of this day job? What about estimated tax payments for that?
Depends on how you want to treat it. If I had a day job and I really wasn't making much on my weekend, I would actually probably change my W-4 with my employer and increase my withholding with my day job employer so that they withhold the tax for me and I don't necessarily have to worry about these estimated taxes. But if you don't do that, you're gonna owe. If you make money at all, it's gonna increase your tax liability, and if it's a side hustle, more likely than not, it's gonna be subject to self-employment taxes, which is an additional 15.3%. So, and that's 15.3% off of your business taxable income. So setting aside 10%, you're like, well, that's not 15.3%, but you have deductions and like the standard deduction, little things like that. That might help with that. But I would honestly, and I tend to do that 15 or that 10% off of gross receipts. And that way you don't necessarily have to worry about what you've spent. If you just take 10% of what you've received and stash it, then after your expenses, it'll meet that 15%. And you can always adjust it too. You know, put in maybe too much right now to be safe, and then you realize, oh, I didn't need that much. Maybe I'll adjust it and I'll only put 9% or only put 8%. Or maybe you make way more money next year and now that 10% is too low and you need to put in 15 or 20%. So always analyzing that. I do projections constantly for people and for myself, just so I know. And I'm constantly making changes. So 1099s and W-2s, I am quickly running out of time. So I'll touch base on this. 1099s, you have to give to anyone who you pay more than $600 a year. The caveat is now that things like Cash App, Venmo, credit cards, they're all required to give 1099Ks. So if you pay someone through Venmo, Venmo is actually going to give the 1099 on your behalf. They're required to, so you don't have to give it. So if you're worried about 1099s, pay people through Venmo. I mean, honestly. But that being said, if you pay someone more than $600, and that includes maybe your son doing yard work at your place of business all summer and you paid them $700, they're technically supposed to get that 1099. 1099s, you send them out at the end of the year to all your contractors. Things that people don't realize require 1099s, rents. If you pay rent to a landlord, you're supposed to give a 1099 miscellaneous to your landlord, regardless of if they're a corporation or not. Corporations are not required to get 1099s, so that's one of the reasons why anytime that I have a contractor working for me, whether it's a plumber who I have come fix the kitchen sink, or maybe it's a tax accountant, I always get a W-9 from them. The W-9 will say what type of entity they are, all of their pertinent tax information, and you'll be able to fill out a 1099 just from the information from that W-9. So I try to get those before I pay someone. That is the ideal world. That never happens. But some people don't want to give it to you after you've paid them. Let's put it that way. So if you say, yeah, I'll pay you as soon as you give me this, they're more apt to give you that W-9. Attorneys are also an exception to that corporation rule. You have to give attorney a 1099 no matter what. They just don't trust attorneys for some reason, I guess. W-2s due January 31st to your employees, also to the IRS, must use the forms. Most of those need to be e-filed. 1099s, if you do 10 or more, you have to do them electronically. Even if you're doing them yourself and you're not using a tax professional, they have to be electronically filed. Part of that is due to COVID, because when they were, fun fact, when the IRS was closed down for COVID, they still got mail. They got, literally had semi-truck full of mail in the parking lot of these centers, and they could not get through all of them. So for the year 2020, they took a bunch of these 1099s and just shredded them. Didn't even look at them. They're now caught up though, but that's one of the reasons why they require electronic filing of them. So W-2s, I wanted to kind of touch base. What is compensation for a W-2? So if you are giving any of these things, there's other things as well, but things that people don't think about. Vehicle allowances. If you have a company vehicle that you allow your employee to take home, or to have, like, during off hours, maybe they're on call or something like that, you need to give them a vehicle allowance and that's not money that you actually give them. It means you have a company vehicle, they have a log, a travel log, and in their travel log, let's say 10% of their travel time in their company vehicle was used to commute to and from home. Maybe it's for to go to their kids' baseball game. That's considered personal use of a company vehicle. And in order for that to be allowed, you actually have to give them compensation on their W-2 for a vehicle allowance or a company use or a personal use of a company vehicle. That needs to be added to a W-2. Gifts over $25. So if you are giving employees that Christmas bonus, thank you so much, here's $100, that technically needs to be added to their W-2. So you're buying your employees lunch. Let's say they're employee of the month and you buy them a $30 lunch. That's actually supposed to be on their W-2 in order to be deducted. So at $25 for the year, it's a very low threshold.
What if I pay for that employee's lunch from my personal account?
Well, that's just
thank
a
you.
gift. If you don't care about deducting it, then that's fine. You can gift up to $17,000, I believe, to any person at any time without any tax consequence. So each year. So B&O taxes, is the same. So the excise tax return, Washington State, if you all have businesses, you're probably familiar with this. So I'll just touch on it briefly, but you have to file your B&O report, also remit your sales tax, either on a monthly, quarterly, or annual basis. Monthly, it's due the 25th of the next month. Quarterly, it's due at the end of the month, the following month. Annually, it's due by April 15th. For an annual filing. B&O is business and occupation tax. Everyone has it. The small business tax credit wipes out the majority of a small business B&O. Childcare, for example, has a carve out. Childcare given to kids 8 years and younger is non-taxable. Childcare to school-age kids is taxable. So most childcares get the small business credit to wipe that out because they don't have enough income to actually be taxable. But it's also sales tax. So you're collecting your sales tax, remitting it at the same time as you do your B&O excise tax return. Here are particular things in Washington State. Of course, this is Washington State specific. That is taxable for sales tax in Washington State. And then things to consider if you are using an electronic platform like Amazon or Wayfair or Etsy, they are required to collect that sales tax on your behalf, and you don't have to remit sales tax for those costs. You still have to report it for B&O purposes, but you don't actually have to collect and remit sales tax if you sell through one of those platforms. That's super helpful when you are selling to other states besides Washington, because if you sell, let's say you sell to Idaho and it's through your own website, you actually have to get an Idaho business license and pay Idaho sales tax to the state of Idaho. If you're selling to New York, maybe you have a website, online presence, people buy directly through your website. Someone from New York buys, you are now subject to the sales tax in New York, and you have to have a business license in New York, pay sales tax in New York. So if you are wanting to sell to the entire country, I would recommend an online selling platform that will do all of that for you so that you don't have to have 50 business licenses from 50 states, but this is Washington specific. These are also Washington specific, things that are not subject to sales tax. Wholesale goods, so you sell something to somebody who then is going to resell it. That's considered a wholesale. You don't have to collect the sales tax because they're going to collect it as the end user. It's the same thing as getting a reseller's permit. So if you go to like Lowe's and buy something and you don't pay sales tax there because you're putting it into a construction project that you are collecting sales tax for from your client. So that's the difference between wholesale and resale. Unprepared foods like grocery store, obviously everyone who lives in Washington knows that you don't pay taxes on groceries, but you do on prepared, which includes, there's something called a soda tax, or a sugar tax, I should say. Anything with excess sugar basically has a sales tax. And anything prepared. So even if you are going to Safeway and buying something from their deli, that's prepared and they will charge sales tax on that. So if you are preparing something, you are collecting sales tax. If you have vegetables that you grew in your garden and you're just selling the vegetables, you do not have to collect sales tax on those. But if you cook them, sales tax. So let's see. How sales tax requirements. So I'll let you go ahead and look at that. You can skip over it. Tracking receipts and mileage. So this is going back to automobile deductions. You can either take standard mileage deduction or actual automobile costs. I tend to, for a small business owner, encourage people to take standard mileage deduction. Why do I encourage people to do it? You have to keep track of less, for one. So when you take actual vehicle costs, you still have to have a mileage log. You have to keep track of the miles that you drive, whether they're personal or business. And then at the end of the year, you take that log and you're like, well, 30% of my miles were personal, 70% were business. You then take all of your vehicle costs and you're only allowed to deduct 70% of those. A lot of people, when they spend on vehicles, they'll only buy gas for their car when they're doing something business. And maybe they'll buy gas personally when they're doing something personal. Or they'll pay for their insurance personally and not through the business. And now you're shorting yourself expenses, if you will, because you're only going to be able to take 70% of those expenses that you report because you have 70% business use, even if you didn't report all of the expenses you had for that vehicle. One reason that people do actual expenses for vehicles, though, is depreciation. So if you have a vehicle, you purchase a vehicle for, let's say, $25,000, you use it for more than 50% business, you can depreciate it and take the cost of the vehicle over the life, which is about 5 years, subject to restrictions. I don't know if you've ever heard, when somebody is looking at a vehicle, is they will get something 6,000 pounds or higher. And that is because a passenger vehicle for the IRS, as long as it's 6,000 pounds or higher, has larger restrictions or less restrictions than a passenger vehicle with less than 6,000 pounds. So that's actual, but again, that's going actual cost. The very first year you have a vehicle, if you use actual costs in that year, you have to use actual costs for the life of that vehicle. You also have to have actual costs per vehicle. So if you have 3 vehicles, you could use standard deduction for one, you could use actual costs for the other, or both, but you have to make sure unequivocally that you know what costs were for which vehicle. So you need to know the actual cost vehicle that you spent this much in gas for that vehicle. If you can't prove it is for that vehicle, because it might be for another one, it might get disallowed. So there's just a lot more to prove when you're using actual costs. And as I mentioned, if you use it for the very first year, actual costs, you have to use actual costs for the life of that vehicle. If you use standard deduction for the first year, you can actually revert to actual costs at a later date, and you can go back and forth. So that's something to consider. But it's a misconception. Often people will put their gas on there and give themselves mileage. That's double dipping on the same expense. And then I just have one more do's and don'ts, just some basic little fun facts, right? Make sure you keep business and personal funds separate. Insurance is important. Maintain your business license. If you let your business license lapse, you also let your liabilities lapse. So even if you had liability protections as an LLC, even as a corporation, once that business license, that entity lapses, it no longer, they can pierce that veil, they can go after you from prior years, even when you had them at the time. Maintain good accounting software. Find a good accounting software. Like I mentioned, I prefer cloud-based. Receipt storage, find some sort of receipt storage. You know, you can do it within your accounting software. You can use Google Storage. You can use Microsoft Storage. Like, there's so many different options. And reconcile your bank accounts. Always reconcile your bank accounts. You'd be surprised how many things that you thought you paid for but didn't. And you'll find that out if you reconcile your bank account. Or you paid for and didn't realize, and you'll find out through your reconciling your bank account. And then always keep yourself educated in your field, in your industry. Look at trends, look at expectations, look at laws. Keep yourself in the know. The last thing you want to do, because not knowing it won't be an excuse. If it's your profession, like, just because I might not know a tax law doesn't mean that I can pretend it didn't exist. I'm still liable for something if I go against it. So constantly keep yourself educated. And there's just a couple of actual apps that you can use for, I think Wave is one of the cheaper options. So I think each one of those are basic, if not free, just as a little fun.
The other one that Amber and I found has free options is FreshBooks, and it is cloud-based.
Yep.
And it is actually one that you can download all your data if you want to upgrade to something later, which is something Amber and I have recently experienced. That can be a challenge.
Yeah.
So I think if you're choosing a software, also find out what format you can download your data in, because some of them are going to make you pay for it, or they're not going to give you back your receipts, or they're going to give it to you in a format that doesn't work. So if you want to start with FreshBooks, that is one that you can download your data in a way that works and switch. And the one I mentioned about tracking time is called Clockify. It is Expensify's best friend, and it will track your time. And there's a free version that is very robust.
Yep. That's my last slide.
Amber, if people want to hire you or your
Yes.
team, how do they do that?
Great question. If I had my contact information, that would be great. My email is CFO, as in Chief Financial Officer, at jasmingroupllc.com, and Jasmin is spelled Jasmin, no E.
I will leave Amber up there while I talk from the back so I don't have to walk in front of the camera again.
You're fine.
As a follow-up, we will give you the slides in a PDF format, and I'll add Amber's contact information to the slides before we send them out to you in the next couple of days. We are being recorded. Once the video is live, we'll also let you know. On our SIMBA YouTube channel, Spoken Independent Metro Business Alliance YouTube, we need to get like a QR code for this. There are 12 or 13 business training videos. One of them is on B&O and sales tax. SIMBA staff can actually assist you with that at no charge. We will not touch your federal taxes. We will tell you how to get ready to talk to someone, but we're not going to file your federal taxes, but we'll help you with your state taxes and help you get ready to meet with Amber. And one of the things that Amber's firm does that I think is fantastic, and I've sent people there who really needed this help, is that they'll help you set up your QuickBooks accounts. So if you don't know how to track certain kinds of expenses, they'll say, this goes to rent, this goes to advertising, this goes to payroll, fill in the blank, unique to your business at an incredibly reasonable rate, so you can track things on your own, so that when you go see your accountant is maybe a little cheaper. So spending a little bit of even that money up front for someone to set up your account for you of what you should be tracking and what's missing and how to reconcile is very helpful.
Yes.
Questions on Zoom in the room? No.
I kept you late.
Thank you so much for your time. Feel free to grab food on your way out. One of the things one of you asked about independent contractors, I think she left, but if you have questions about independent contractors versus employees, there's some L&I guides up there, and there are some about all kinds of industries, so take some of those as well. We have a ton of them. And thank you so much.
Yeah.